The crowd always thinks wealth is made in clean conditions. They imagine the great fortunes are built when the sky is blue, the headlines are calm, the economists are confident, and every chart looks like it was drawn with a ruler. That has never been my experience. The biggest money I ever made did not come from comfort. It came from confusion. It came from moments when the public mistook noise for permanent damage and started throwing good assets into what I think of as a panic auction. That is the frame I want you to hold. Because if you miss this frame, you will misread everything that follows. A war breaks out, oil jumps, television fills with maps, missiles, and very serious people using the phrase "this time is different." The market wobbles, retail investors start to sweat. Social media fills up with prophets selling doom by the pound. Everybody suddenly feels the same impulse: run first, think later. That is exactly when the panic auction begins. And when a panic auction begins, you learn very quickly whether you are an owner or merely a spectator with a brokerage account. I have watched this pattern repeat too many times to treat it as some exotic mystery. The details change, the slogans change, the geography changes, the costumes change, but the structure is stubbornly familiar. A crisis arrives. Uncertainty expands, prices reset lower because fear demands a discount. The public confuses a temporary shock with a permanent change in value. Then slowly, sometimes annoyingly slowly, the auction clears. Good assets recover, the strong get stronger, the patient get paid. The emotional spend years explaining why they almost bought at the bottom. That's not poetry, it is market behavior. When people ask me where the great wealth windows come from, they usually expect some secret. They expect a hidden industry, a once-in-a-lifetime technology, a politician, phone call, a number nobody else has seen. Usually the answer is much less glamorous. Great wealth windows often come from one very boring advantage: the ability to stay rational while everybody else is borrowing their emotions from the nearest headline. That is why I do not start with predictions. I start with structure. A lot of investors make the same mistake every single cycle. They think the job is to predict the next 6 weeks. That is not the job. The job is to recognize when the odds have tilted far enough in your favor that you no longer need perfect foresight. You only need discipline. This is where history becomes useful. Not because history gives you certainty. It does not. It gives you context. And context is often enough to stop you from doing something stupid. Look at what usually happens when war arrives while the stock market is near highs. The first move is almost always the same. Uncertainty widens. Prices fall. The market hates not knowing how far a conflict will spread, whether oil will spike, whether inflation will reaccelerate, whether politicians will mismanage the response, whether consumers will pull back, whether businesses will freeze. Nobody can model uncertainty cleanly in the first few weeks. So the market does what it always does under uncertainty. It marks prices down until the fear is paid for. That markdown is not the whole story. It is the opening bid of the panic auction. What comes next is what matters. After the first hard wave of fear, the market starts doing what markets always do. It separates permanent impairment from temporary stress. It starts noticing that businesses still sell toothpaste, software, chips, insurance, groceries, payment rails, data, medicine, and cloud capacity, while television still screams about the world ending. It starts noticing that the economy does not require perfection to keep functioning. It starts noticing that liquidity still has to find a home. And it starts climbing long before the average person feels emotionally ready to believe that climbing is allowed. That last point matters more than most people realize. The market recovers before the public recovers. That is why waiting for emotional clarity is often so expensive. By the time the public finally feels safe again, the best prices are gone. If you want proof of that, you do not need a mystical theory. You just need a memory longer than the last headline: Iraq, Ukraine, the pandemic, regional conflicts, debt scares, banking scares. Every time, the language changed, but the human behavior did not. Fear hit first, prices dropped. Experts warned you. This time was unique. Then time did what time always does. It forced reality to outrun the story. The story was panic. Reality was recovery. Now let me tell you where a lot of otherwise intelligent people get trapped. They hear a message like this and think it means one thing only: buy every dip no matter what. That is not what I am saying. Blind dip buying is not discipline. It is gambling with better public relations. There is a huge difference between preparing for volatility and worshiping volatility. One approach makes you wealthy. The other makes you a motivational quote attached to a margin call. You do not buy simply because something is down. You buy because you understand the machine underneath the price, and you have reason to believe the machine still works. That is why I always prefer broad productive assets for most people. If you own a broad market ETF, you are not being asked to guess which individual company will survive, adapt, dominate, or fall apart. The fund quietly handles part of that work for you. Weak companies lose relevance, get removed, and make room for stronger ones. The basket keeps evolving while you keep owning the productive system beneath it. That is one of the most underappreciated advantages in investing. The index does not ask you to be right about every name. It asks you to keep faith with productive capitalism long enough for the weak to be replaced and the strong to compound. That is a wonderful structure for a human being who has a life to live. Now, if you insist on owning individual stocks, that is a different game. It can work brilliantly. But now you need more than courage. You need actual judgment. A good company bought in fear can become life-changing wealth. A bad company bought in fear is just fear with a new address. And beyond judgment, you need conviction. Because good companies do not always reward you on your timetable. Sometimes they fall 40%, sometimes 60%, sometimes 70%. The question is not whether that feels bad. It does. The question is whether the business underneath the stock is still the kind of machine worth owning, when everyone around you is treating the price chart as if it were a diagnosis of terminal illness. That is why great stock selection and strong conviction belong together. One without the other is useless. Now let me come to oil, because that is the ghost most people see. First, when a Middle East conflict shows up on the screen, the fear is always the same. Oil goes up, inflation returns. Recession follows. The central bank loses control. We relive the ugliest parts of the 1970s. The market sees that movie in its mind and immediately starts pricing in some version of it. I understand the instinct. I do not respect the laziness. Oil shocks are real. Higher energy costs matter. But a temporary spike in oil is not the same thing as a self-sustaining inflationary regime. People talk as though oil itself prints money. It does not. Oil can create pressure, it can create discomfort, it can create a tax on consumers and businesses. But broad inflation becomes durable when monetary conditions allow it to spread and stick. That distinction is not academic. It is the difference between a temporary commodity shock and a true long inflation cycle. And there is another simple fact most people ignore because panic makes them forget basic economics. Very high oil prices destroy their own demand. There is a level at which expensive oil starts choking the very activity required to sustain those prices. Consumers cut back, businesses adjust. Marginal demand disappears. Substitution happens. Pressure builds politically and economically for more supply and less waste. A spike can be violent without being permanent. That is exactly why basing your whole investment life on the assumption that an oil surge will simply continue unchecked for years is usually a poor bet. The market knows how to overpay for extreme short-term fear. Now, none of this means you should dismiss the conflict, laugh at risk, or assume every dip is small and every recovery immediate. That would be foolish. Volatility can go on much longer than people want. Markets can overshoot in both directions. Drawdowns can deepen after you buy. A month after the opening shock, the market may look wiser than it did in the first week. 3 months later, it may look dumber again. That is the nature of auctions driven by fear. They do not clear in straight lines. That is why the real edge is not prediction. It is preparation. Preparation means 3 things: mental cash, actual cash, and a rule set strong enough to function while your emotions are temporarily useless. A lot of people claim they want to buy when everybody else is fearful. Very few actually prepare for what that requires. They do not build cash reserves or deployment plans. They do not define the intervals at which they will buy more if prices fall. They do not think through what happens if their first purchase is early and the market drops further. They do not distinguish between lump sum bravery and systematic opportunism. They tell themselves they will be bold in the crisis, then discover in real time that boldness without a process is just theater. This is why I like dollar cost averaging so much. Especially when volatility expands, it solves several human problems at once. It keeps you in motion. It stops one bad entry point from defining the whole journey. It preserves some dry powder. It lowers the emotional drama of every individual purchase. And most importantly, it allows fear to become your discount rather than your paralysis. If the market falls after your first buy, good. Your next dollars work at a lower price. If it falls again, good. The following dollars work even harder. If it recovers before you deploy everything, good. You still bought. People who understand compounding do not demand the perfect bottom. They demand continued exposure to valuable assets at acceptable prices over long periods. That is a much saner standard. The public loves one-shot heroics, buy the exact bottom, nail the perfect stock, predict the exact turn. Those stories sound dramatic, but they are not how most fortunes are built. Most fortunes are built through repeated sensible exposure to productive assets, while other people keep interrupting themselves. That is why I prefer the prepared buyer to the heroic buyer. Prepared buyers survive reality. Heroes usually get interviewed by their own regrets. Now let me tell you something else the public gets wrong during volatile periods. They assume safety lies outside the market entirely. They imagine they can sit fully in cash while the storm passes and then calmly re-enter when things are obvious. That sounds sensible until you study what actually happens over time. More money has been lost waiting for obvious than in many corrections themselves. Why? Because obvious arrives after the price changes. When the storm is at peak intensity, prices are attractive, and confidence is absent. When confidence returns, prices are less attractive. That is the trade. You do not get both. You either buy while fear is offering you a discount, or you pay up later for emotional comfort. Most people pretend they are choosing prudence. What they are often choosing is a more expensive entry. This is not a moral issue. It is just the market charging for certainty. And the market charges a lot. Now, I want to say something important about time horizon, because it is the great secret hiding in plain sight. The shorter your horizon, the louder every crisis sounds. The longer your horizon, the smaller each crisis becomes relative to the machine you own. Look at enough market history and a strange simplification appears. Over long enough periods, most of the terrifying events collapse into squiggles inside a rising structure. That does not mean pain was fake in the moment. It means productive systems have a tendency to absorb fear and continue moving. Bear markets happen. They can be vicious, but the average bull market has historically been longer, larger, and far more wealth, producing than the average bear market is wealth. Destroying that asymmetry matters. It means the long game is statistically kinder than the short game. Day trading asks you to win against noise. Long-term investing asks you to align with gravity. I know which game I prefer. If you hold for a decade, the odds improve dramatically compared to what happens when you try to outwit the next quarter. That does not mean every decade feels good while you are in it, but it does mean the market has an astonishing habit of rewarding patience while humiliating urgency. And here is where the panic auction becomes so powerful for the prepared investor. When war or crisis hits, the public temporarily forgets the long game. It starts acting like the next month is the whole future. That emotional compression creates mispricing. People sell assets priced for 10 years because they are frightened of 10 weeks. That is the entire opportunity. You do not need to know the next headline to exploit that. You need to know that ownership of good assets over long enough periods tends to beat panic over short ones. That is enough. Now let me make the distinction even sharper. There are two very different types of investor behavior during a crisis. The first is the gambler. The gambler sees the drop and goes all in because surely this must be the bottom. If the market falls further, he has no ammunition, no flexibility, and no emotional stability left. He is not investing. He is trying to get the casino to clap for him. The second is the prepared owner. The prepared owner has already accepted that he cannot predict the perfect bottom. He also knows the future is usually kinder to patient ownership than to frightened waiting. So he builds a plan, he buys in stages, he keeps some reserves, he knows what he is buying and why. He can explain it to a 12-year-old. He does not need the market to validate him tomorrow morning. He needs only enough conviction to keep executing while others are improvising. That second investor is the one who captures generational wealth. Not because he saw the future more clearly, because he behaved more sanely when the future was temporarily unclear. Now, some people listening to this always want a list. Fine. Here is the practical version. If you are a broad market investor, keep buying your ETF. Let the structure do its work. Use volatility as an ally, not a reason to freeze. If you have extra cash and valuations improve, buy more methodically. Do not demand the exact bottom. If you are an individual stock investor, make sure you actually own businesses worthy of a decade. Cheap trash is still trash. Fear does not transform bad balance sheets into great opportunities. But if you own strong businesses with durable economics and the market offers them to you at panic prices, that is where wealth can be accelerated, if your conviction is stronger than your appetite for applause. Take profits where risk has gotten silly. I have no objection to trimming oversized winners. That is not bearish. That is gardening. You cut back what has grown too large so the rest of the portfolio can breathe. But trimming because you understand risk is not the same as dumping everything because the world feels noisy. Do not confuse management with surrender. That confusion has cost people a lot of money. Another thing worth understanding is that the United States remains the global refuge in periods of fear, whether people like admitting it or not. Money runs toward stability, liquidity, institutional depth, reserve, currency, credibility, and the world's deepest capital markets. That does not mean America is flawless. It means in a frightened world, relative safety still has a home, and large flows keep proving where that home is. Investors who keep betting that some overnight alternative will displace that structure tend to mistake fantasy for timing. That is why crisis often strengthens the very market people were told to abandon. The irony is almost cruel. Now let me bring this all back to the one sentence that matters most. The next 12 months in a volatile war-driven market are not a forecast, they are an environment. And some environments are especially favorable for patient capital. That is what we have here. Not because the news is good, because the news is chaotic enough to keep handing discounts to people who know how to use them. This does not mean the ride will be clean. It almost certainly will not. You may see new lows, you may see violent reversals. You may see oil spike again, you may see inflation fears surge and fade and surge again. You may see experts screaming for the hills and then quietly buying under the table. Ignore the theater. Focus on the auction. If you understand that markets usually oversell uncertainty, that broad productive assets tend to recover from wars, that oil shocks are not the same as permanent inflation, that long-term horizons beat short-term panic, and that prepared buying beats heroic guessing, then you already understand more than most participants. That is enough to change your financial life. A lot of people imagine generational wealth comes from secret information. Most of the time it comes from ordinary information applied with unusual consistency during extraordinary stress. That is what I want you to remember. When the next drop comes, and it probably will, do not ask whether the world feels safe. Ask whether the auction is offering you productive assets at a discount large enough to justify disciplined action. Do not ask whether television has stopped panicking. Ask whether your time horizon is long enough to let sanity beat fear. Do not ask whether this dip is the bottom. Ask whether you are prepared to keep buying if it is not. That is the game. And the investors who win it are usually not the loudest, the fastest, or the most certain. They are the ones who treated volatility like a sale, while everyone else treated it like a verdict.